Thank you, Stephen. Can I just get the panelists up here? Thank you very much. Did anybody have any problems just then with the app? Because just one person sitting next to just had a slight freeze on it. So did it work okay? Nobody had any problems. If you have any problems, the technicians in the corner would love to hear from you. So this morning, I'm pleased to welcome you to the first panel. I'm not going to read out everybody's bios, which is commonly done in these situations, because it's in the app. So again, trying to force you all onto that new piece of technology. Obviously, we are going to be looking at the questions. I can see them on my pad. At the moment, there aren't any. I've put in a couple of rather stupid ones. You'll have to forgive me. I just wanted to see if it was working. But as the questions come through, we will try to include them in the conversation. And we're going to go in just a second on to the first poll. In fact, if we could bring that up to get things started, we're a couple of minutes behind schedule. Can you bring up the first poll? I think we've gone through the explanation before. Obviously, the polling question, you have to go to the part on the front that says polling. Given that this is a marketing panel, we'd like to ask the question, which country or region outside of the UK do you think will provide the best money-raising opportunity in the coming year? So your options are the USA, Asia being just China, Asia excluding China, the EU, the Netherlands, Scandinavia, and Luxembourg. It's supposed to be in the slightly easier countries, and the EU, France, Germany, Italy, Spain being the slightly harder countries if you're operating under the private placement regime. EU other, obviously Switzerland, Middle East, and then other. There's a lot of choices. You can answer with multiple answers in terms of what you think is going to be attractive for you in the coming year. And so if everybody's ready, we'd like to go to the poll. So you have about 10 seconds now, I think, to answer. So please vote now. Okay. Well, so everybody apart from Pat can now leave the stage, and because I think that's pretty much what we were expecting, in line with, very much in line with expectation. I'm glad, because we sort of prepared for that. So we're going to try to proceed with this. Obviously, again, questions are welcome. The questions, if you vote on questions, it makes it harder for a moderator to ignore them. But as you may have guessed, I'm American, so I can ignore all of you. I had tons of President Trump jokes, and the people of Iowa last night kind of ruined it for me, but maybe saved the world in one way or the other. So I can't get too angry about that. As a very brief introduction, I just was reading the other day, and those of you who are AIMA members, always a good idea, and or clients of PwC, may have read the Global Hedge Fund Distribution Survey of 2015, which was called Distribution Disrupted, a Spotlight on Alternatives. I just read it. I did read the whole thing, but I found the opening paragraph particularly interesting. I'm just going to read it very briefly as a segue into the panelists today. Regulation sparks distribution awareness. A rapidly evolving regulatory environment has focused minds in the hedge fund industry. Systematically identifying and targeting sales channels and targets used to be an opportunistic rather than strategic activity at many hedge funds. But in the wake of new regulation, many firms are developing sophisticated processes to decide which investor channel or channels and which markets to target and, consequently, which regulatory regimes they are prepared to address. I think that does talk a little bit about a changing world. It used to be that, you just went out there and as again, opportunistic was definitely the approach. But now, with all these new regs and various issues that have come up, people are having to focus a lot more. So without further ado, we'll kick off with, as expected, our first speaker today. Pat Shea has flown over from Boston, our Boston office. And obviously, Pat, the answers here are pretty clear-cut where people want to go and get money. Cordium's U.S. operations primarily serve U.S. resident managers, but also many non-U.S. managers are looking at that marketplace and getting registered over there increasingly. So I think the members of the audience still do find the U.S. regulatory environment a little bit confusing. I'm American and I find it confusing. So you can highlight perhaps the key regulatory issues a UK manager needs to consider when marketing into the United States.
Sure. Certainly, as the poll shows, I think there's definitely an interest from managers to raise capital in the United States. And also just the concept of U.S. investors looking to diversify into non-U.S. asset classes as well as non-U.S. managers. So that's not surprising, and as Joe mentioned, a little bit of what we expected. And I based in the U.S., often get the question from European and UK managers about this concept of coming to the U.S. and marketing. And there are a number of regulatory subjects and regulators that get touched as I try to do a quick overview of what to pay attention to. I'll start with where I think probably the topic that people jump to most immediately, which is the concept of registration as a broker-dealer. In the U.S., under the FINRA rules, you're not allowed to sell securities in the United States unless you're appropriately registered or exempt. And the exemptions there are, I think I'm going to talk about a few things, some of which are becoming a little bit less clear. Others are starting to broaden a little bit. But in the FINRA area, in whether or not one needs to be registered and have your salespeople registered as registered representatives under a broker-dealer, it can be a little difficult to look at the exemptions. They're few and far between. The issuer exemption from broker-dealer registration is the one that most people look to. And that has been something that in the U.S. as well as outside the U.S., firms that are not covered under a broker-dealer have used through the years. And the concept there is that you're not paying your salespeople sales-related compensation, so you're not paying commissions and you're not paying that type of transaction-based compensation. Those individuals have responsibilities outside of sales, so they may have some operational component. You look down to actually the job description and it is expanded. But the piece that has come into focus, the element of that exemption that's come into focus over the past couple of years is related to the concept of how frequently you are offering. So if it's something that's continuous and the salesperson has offered for that issuer over the past 12 months, the David Blass speech a couple of years ago and also the Rasseneur case that came out have brought that that issuer exemption. To the extent firms are relying on that, it's something that you should be talking to your counsel about, you should be talking to your lawyers about, and understanding the risks that are associated with that. Beyond the issuer exemption, other things to look at, there are some narrow cases or I guess experiences that I've seen where people are looking at the foreign broker-dealer exemption. So you would actually align yourself in a chaperoning situation with a U.S. registered broker-dealer. That can bring in heavy aspects of compliance both from the non-U.S. manager as well as from the U.S. BD. So it's not something that we see all that frequently, and in addition, that's typically looking at very high-level institutional type qualified purchaser type investors. The other thing to I guess as you look at it from the other angle, what do you do about broker-dealer registration? I think some of the things to look at would be setting up as a registered BD. You've got the opportunity to align yourself with a solicitor or a broker-dealer that would actually be that arm of your business to go out, and that's typically done through an agreement, and there's a compensation arrangement. So to the extent they are able to refer investors to your fund, there would be a fee that you would pay to that solicitor. So that's an approved channel. The other area which some firms have used, which I'll mention, I guess, just as a word of caution, is also the finder's exemption. So certain people look to introducers. They are not registered broker-dealers. They're actually claiming the finder's exemption. And that's something, a loophole that has certainly been narrowing over the years, and that's the Rasseneur case that I mentioned, which was actually interesting in the sense that the individual who was doing the introducing without a broker-dealer registration, the finder's exemption, just to take a step back, has always been you do nothing but introduce. So you just take the investor, you introduce them to the manager, and then you step out of the equation and you let the manager handle that. And so the Rasseneur case was interesting because it implicated not only the individual who was doing the introducing and much more, so overstepping the finder's exemption, but also the firm that hired them, Rasseneur Capital Partners. So that's something to pay attention to. Another concept which we're keeping a close on, and this is fairly timely, is the concept of a capital acquisition broker, or CAB. So another thing to think about as you get back, and if this is something that you're paying attention to, this would be a limited purpose broker-dealer registration for those, and there are a number of things that you can do, but for our purposes today, for those that are actually just looking to sell interests in private funds. And it's something that would be, call it broker-dealer light to some extent. Again, looking at very high level or high quality institutional type investors. So the proposal that we've seen over the past several weeks and where it seems headed is that this would actually just be referring investors to a 3C7 fund, so very qualified purchasers. So that, I think touches on the broker-dealer pieces. So you've got registration, you've got some exemptions, you've got the use of a solicitor. The other pieces, the other regulatory components to pay attention to, I think just to understand conceptually, and what we're talking about in each of these subjects is registration versus exemption, and I'm trying to just walk the line and show you both sides. The private funds, so your 3C1, 3C7 funds, from a U.S. regulatory perspective, 2 levels of exemption to pay attention to there. The fund itself is not registered as an investment company. It's not a registered mutual fund. And the securities that you're offering are also not registered. So to pay attention to that exemption, you've got your investor eligibility components that I think most people are familiar with, your 3C1 accredited investors, your 3C7 qualified purchasers. On the security side, you've got the concept of avoiding general solicitation, avoiding general advertising. And that has always been the rule. So that is why in our world, this marketing ends up being one-on-one meetings with known institutional high-quality type investors and not doing something through a website. In this area, I'll note a couple things that, again, now I think we're going in a different direction. We're actually kind of expanding these exemptions and their usefulness to some extent. People are probably familiar with the Jobs Act, which came out a couple years ago and allowed general solicitation and general advertising, but you would need to, in your Form D, which is the form where you put yourself on the radar of the regulator, you would check that you're actually engaging in that 506C general solicitation, general advertising. That's one piece. The other is that there was guidance as well as no action around this avoidance of general solicitation and general advertising. The concept has always been that you will not engage in an offering of your fund unless and until you've developed a substantive as well as a pre-existing relationship. When I would go out and see my clients and do my training, I would say the substantive piece is making sure that you know that your fund is a suitable investment for that investor, and being able to document that and to show that. The pre-existing piece, we always use 30 days as the gold standard in terms of when did you start speaking with that prospect and when did you actually make the offer. And you can imagine that marketing professionals could not believe a waiting period of 30 days. The guidance in the no action letter, which came out last year, really clarifies that it puts more onus on the substantive piece, so making sure that you've really drilled down on the suitability from an investor perspective. And what that case was, which was the Citizen VC guidance, it basically gets at an internet provider that is going through a nice process of gathering information, reviewing the information that they get back from the prospective investor, really clearing them and showing the steps along the way before they give them a username and a password. So that's something to just pay attention to in terms of that, the marketing piece. We have not seen many clients take advantage of the Jobs Act. I think I think that's consistent with what people just haven't made the leap to actually start to do television ads and radio advertisements around private fund investing. I think it's a little bit more cultural, but it's also a little bit of trepidation around not wanting to be the first. I mean, there are certainly some firms that are doing it, but there aren't that many. Beyond that, in the time that I have, just briefly, other things I think people are familiar with SEC registration as an investment advisor and paying attention to the available exemptions, whether it's the foreign private advisor exemption or the private fund advisor exemption, which carries with it the exempt reporting advisor status. So you need to pay attention to that because That means, do you have a place of business within the United States? Do you have individuals on the ground who are providing investment advisory services? Or are you just from your jurisdiction here, are you just sending people over? That can impact whether or not you need to be registered or exempt. You've also got the concept of CFTC, and we talked a little bit about it. It's a very, very technical and dense subject, but something to pay attention to make sure that you're looking at your pools, you are understanding your use of commodity interest within the portfolio, looking at the exemptions that may be available to you. The 413A3 exemption is still something that allows you to stay exempt from a registration as a commodity pool operator or commodity trading advisor. The 4.7, which is also a very popular registration light exemption or exclusion, is something that many people fall to, but then that does carry with it the obligation of becoming a registered CPO. And then lastly, again, very quickly, just know that your marketing materials, the things that people bring, the pitch books, the DDQs, any website information, to the extent you are regulated and you are examined, that information will absolutely be reviewed. It will be, statistics in there, data in that document, whether it's performance related, whether it's assets under management, whether it's attribution analysis, whatever the case may be, that will be reviewed, it will be back tested, it will be rechecked, and there will be questions about that. So from a marketing, from your documentation, just make sure that you've got a compliance process in place to keep an eye on that from a disclosure perspective and operationally with respect to accuracy.
Okay, thank you for that. There have been a couple of very, very brief questions here on the U.S. side. I just wanted to, there's two already on there that are quite similar. In fact, if you can, give me some sense for which ones you find useful here. One question here for you, Pat. What is the one thing that a compliance officer of an exempt USA advisor using Reg D, Rule 506, to market institutional investors must monitor regularly? Is there such a thing as just one specific thing they should be mostly careful about?
Yeah, I mean, I would say that it gets to the last point that I moved through pretty quickly, which is to make sure that you do two things. You understand all of the collateral, the information, the material that is being used in that level of marketing. So you've reviewed it, you've signed off on it, you understand what versions are being sent. And then secondly, as a CCO in that situation, I would want to very clearly understand the process. So who are you meeting with? How did the meeting come about? Because again, if you're trying to claim that exemption, you're going to want to look at the exemptions that I just went through. So broker-dealer status, you've got CFTC, you've got SEC, and you've got the concept of your private funds remaining exempt both as investment companies as well as on the security level. So I would make sure that I understood certainly the materials, but also the process and who the prospect is and how it came about.
Okay, there are actually some more questions coming in. Thank you for that. We're going to try to get to those at the end because we just got to get through the rest of the panel, but I will come back to the ones that are on here. So moving on to Stephen. Again, thank you again for coming. Particularly interesting for us that you are the Swiss specialist at Schulte's, apparently, which is great. So perhaps you can explain to the audience, we've obviously been watching Switzerland go from a very low regulatory environment really to a much higher one in the last year or so, and the new marketing regulations have come into place. Perhaps you can just remind everyone what you need to do to market into Switzerland, which is actually, in my mind, slightly surprisingly low in terms of the scoring behind us, but I still think it's a very important place.
Yeah, okay. Well, so good not to be talking about AIFMD for once, so thank you for Switzerland. Two key concepts just to remember before we run through the requirements. Types of investors. There are now three categories. There are two types of qualified investor, and those are regulated qualified and unregulated qualified, very important dividing line between the two. And then there are non-qualified, i.e. retail. Unless you have a UCITS fund and you've registered it with FINMA and gone through the more lengthy process, you can't touch non-qualified retail. So if you're looking at a non-UCITS fund, which most of you, not all of you, will be, then you have a basic choice. Do you want to target just the regulated qualified investors, or do you want both regulated and unregulated? And that decision triggers the extra requirements, depending on how you answer that. The second key thing to remember is the word marketing in the regulations as such doesn't exist. That's the EU's own AIFMD concept here. It's distribution. There is a concept of reverse inquiry, which is the opposite of distribution. It's not distribution, but it's very narrow. Important point to remember. This regime applies to all types of funds that are non-Swiss. So whether they're UCITS or non-UCITS, whatever variety, private equity, hedge, long only, anything, you name it. The key thing then comes down to the categories. So who's regulated, qualified? You can probably answer that in your head. It's intuitive. So banks, the central bank, securities dealers, regulated fund managers, and insurance companies. There's a trap for the unwary with regulated fund managers. Not every fund manager or Swiss advisors in particular at the moment are not regulated for this purpose. Many of them we find in practice misdescribe or are apt to misdescribe their status, and you can be misled into thinking that they're the regulated qualified when actually they're the opposite. They're not regulated. So those categories you can approach, provided you yourself are regulated, and there's a point for startups in there. If you haven't yet got your asset management license here in the UK or elsewhere, you can't do anything. You can't do any distribution, even to regulated qualified. So if you're in that boat, you need to talk to Joe and go to Mirabella or wait. And on the unregulated qualifieds, if you want the extra reach, if you want to approach these people and distribute, and we'll come on to what that concept just briefly means in a second, then you need to do the new stuff, which we'll come on to. So pension funds, ordinary corporates, high net worth individuals, another trap for the unwary. They have to have opted in. You have to have done some diligence. They have to meet the different criteria. There's 2 different tests. They're very MiFID-esque. You'll be used to them once you see them. Trusts and family offices, another trap there. Family offices isn't a category under the Swiss rules. In practice, they can be any one of 3 different things. It could be a corporate. It may or may not be a regulated fund manager. And the default, probably it's one or more high net worth individuals. So how you categorize a family office and where it slots in, it isn't always immediately obvious exactly what you're dealing with. And then lastly, discretionary clients of Swiss banks and others. If you're approaching them directly, you would also be on the side of needing to comply with the new requirements. So translate all that. The key question is, do you want to limit, are you happy limiting who you approach to the regulated type of audience? If so, provided you've got your own license, you don't need to do anything special or new. But if you want the extra reach, then you need to do the new thing. So even if you say, I'm only going to target regulated qualifieds, you still need a good process for vetting and understanding who you're approaching before you approach them. Because if you get it wrong, you've immediately committed a criminal offense. So you ought to have something in the form of a QI certificate, or make sure that you know where to go. You can go to the FINMA website. There are spreadsheets you can download to check who is regulated. Always look at a target's website if they have one. You'll often find more helpful information about what they are on their own website than you will on FINMA's own regulatory website. So be careful, look before you leap. Make sure if you're legal or compliance or operations, make sure you can control and keep an eye on what your marketing folks are doing. And if you're a marketing person, you need to understand you have to know who you're approaching before you approach, because if you get it wrong, there can be a consequence. So if you want to go the step further, then what would you need to do? Well, the process is quite simple. 4 or 5 different things. You'll need 3 different agreements. You'll have a Swiss representative agreement. You'll have a distribution agreement. Both of those will be with this creature called a Swiss representative. They're a licensed animal in Switzerland. They're regulated by FINMA as such. And effectively, they're there to keep an eye on you and will oversee you. They'll approve your marketing materials, or bits of them, not all of them, only certain parts of them. And secondly, you'll have to have your fund appoint a Swiss bank as a paying agent. So you have 3 agreements. Mostly those are based around S-Pharma template documents. There is limited negotiation of the legals in each of the agreements, but they're pretty straightforward things to put in place and fairly quick. The third thing is you'll have to have, and that's the core of the whole regime, a good process for monitoring and that you're complying with the regime. In other words, you can only distribute to and talk to qualified investors. So once you've done all this stuff that I'm describing, the ongoing to-do is make sure everybody signs your QI certificate before you have a conversation with them about any product or before you send them any marketing or other materials. The first thing you do is sign here. Tell me which category of QI you are. And if you have a good process, there'll also be certain other undertakings that you would ask certain categories of qualified investor to say to you. Fourthly, you'll need either a one-page, because it's very brief, there's only 6-line items in it, Swiss supplement, or you'll put the Swiss disclosures in your OM or prospectus. The Swiss rep will usually want to see those and sign off on them, but nothing like an Article 23 set of disclosures under AIFMD. It's literally less than a page, so very, very skinny on the disclosure front. And ongoing disclosures, none, pretty much. There'll be other provisions that you would want to have put in your subscription documents or application form, particularly a QI rep, and you're required strictly only to get that at the point of subscription. But obviously, you don't want to start having a dialogue and talking about promoting a fund unless you've first vetted at the front end that they are QI. So in practice, you'll do it twice. You'll get them to sign your QI certificate. You'll have your dialogue. Hopefully, it will proceed. And when they invest, then in the subscription document, at that point, they will also represent that they are still then a QI. And the latter is the requirement that you mustn't overlook because that's baked into the regulations. Marketing materials, and apply common sense on what that means. All forms of marketing materials have to have a certain few lines of Swiss language in them, and it's that only, strictly speaking, that the rep is required to see and check that you've included and sign off. When it looks at your marketing materials, it's not like the SEC would if they come and inspect you. They're not going to crawl over all the interesting statements and benchmark them and check them. So it's a very limited thing that they're looking at in marketing materials. And then lastly, and many folks will have just done it if you've done it on time. If not, you're late. By the end of January each year, you'll be required to give a standard form certificate to your Swiss rep, confirming that you've complied during the year with the distribution regime. So that if you've got it wrong, obviously then there could be some comeback from your rep, indirectly, in theory at least, from FINMA, but I think in practice that is unlikely. The bit I skipped over, and I'll do quickly, because I know you've got other questions for me, I think, Joe, and the audience may too, is what's distribution and how can you avoid it? Can you avoid it? Well, distribution's very broadly defined. So it's offering or advertising a fund, and that it covers any type of activity whose object is the purchase of shares in the fund. Object, meaning it's a purpose test. You know when you're marketing and when you're not, and when you're trying to procure. So it'll catch pretty much everything that you try to do when you're trying to spark interest with a prospect. Via whatever means, document, verbally, any media. And then reverse inquiry, well, can you live within that? And we'll talk a bit, Catherine's going to talk about that and the joys and the pain of that across the EU under AIFMD shortly. It's very narrow as a concept in Switzerland. It's very tightly defined. FINMA takes a very restrictive view of it. It has to be at the instigation or at the own initiative of the would-be investor. And more importantly, the key words are it has to be without prior action or contact. Just dwell on those words for a second, without prior action or contact. They genuinely have to approach you out of the blue. We could come up with 20 scenarios, and I'd probably end up saying 15 out of 20 or more will not be reverse inquiry. You cannot play the game here with Switzerland like many are still, and we all are in the EU, where you've written to people saying, would you like to continue getting my newsletter, even though you're just a prospect? If you get advice from the Swiss lawyers, they'll tell you in a flash, that doesn't work. That's not reverse inquiry. You're probably distributing by winging out your newsletters. So if you've got Swiss prospects on your list, you might want to, and you haven't stepped in and appointed a rep and a paying agent, you might want to reconsider that as your tip for the day. So very tightly defined. Where's the low-hanging fruit? Stick to the regulated qualifieds. You can If you can attract them via, particularly the Swiss banks, you can send your marketing literature to the bank. It's a regulated creature. Strictly speaking, it, subject to some local Swiss rules, can actually wing them on if it chooses to certain discretionary clients. But you can take discretionary client money in via a bank, provided you only deal with the bank and you don't send your materials directly to, and you don't meet, ideally, and don't start talking about the fund to an underlying client of the bank. So that's the easy entry point, but you still need a good process and to be aware what the categories are. And what you should not trip over, even if you've decided to stay out, is you must be very careful you don't start talking to someone who isn't qualified at all. And you are capable of getting it wrong if you haven't studied the criteria in detail. It's not foolproof, so just be a little bit careful how you go about things and what the categories are.
Okay, yeah, thank you for that. Just one follow-on question. How many, do we have some sense for how many people have opted into the Swiss environment during the time?
Yeah, I mean, we're just under a year, coming up for a year on the 1st of March, and I was having this conversation literally more than a year ago with a lot of my US partners and colleagues, and they were a little skeptical how many would step in. And overall, Switzerland, I think, is still probably number 2. If we looked at our chart, the UK would be the biggest EU domicile, where the numbers of non-UK managers have notified to market in, certainly under AIFMD, around about 1,000 perhaps. But Switzerland, looking at the larger new reps that have emerged, I would say roughly there's about 700 managers and 2,000 non-UCITS funds have stepped in. And if you compare that to the UCITS fund world, which has been able to register and get approval in Switzerland for many, many years now, there are about 6,000 UCITS funds that have registered with FINMA. So it's clearly, whether they're all raising capital is another question, but there is a very strong perception that that is a good hunting ground, and it's second only to the UK in terms of numbers, those who filed.
Interesting, okay. Great, well, thank you for that. I think what we'll do is keep it moving along just from a timing perspective. Moving on to Catherine now. You have the clicker there in case you want to. Yeah. We're going to move on to the first slide if we can. I'm not sure if, hang on, they're just going to do that for you. There you go. So Catherine got up at 4 o'clock in the morning to be here, so we really appreciate her effort coming in from Luxembourg. Catherine, basically AIFMD is almost 2 years old now. Can you give us your perspective on how the passport is actually working?
Yeah. Yes, you're right. It's nearly 2 years and a half that now the passport is there, even if I would say, okay, the implementation has been quite difficult in the various countries. It's not still done everywhere. But now the passport is working, and globally speaking, I would say that if we look at what the manager are saying, it's working, then it's really often used. That passport is really something that is appreciated by the manager, and I would say especially by big managers, maybe because the constraints that are behind are maybe more easy to face by big managers. That's right that at the beginning it was a real issue because it was not clear at all what the local authorities were requesting, so we had to do application file, and we didn't really know what had to be included in this application file. Of course, we had the directive, but there are some local requirements that were not clear at all. And I would say that even now, from time to time, we have surprised with the local authorities. But globally, based on experience, we know that there are some requirements from the authorities, and this is what the industry is still complaining about, because initially the idea was to say, wow, it would be great, we will have a passport, so it will be easy to do, and it will be the same with an harmonization all around Europe, but it's not the case. There are still local requirements, and this can be really seen as an issue. Talking about these discrepancies between the various countries, I would say that the first one maybe is fees, because you still have to pay some fees to certain local authorities, not all, but in certain countries it can be seen as very expensive. I'm thinking about, for example, Germany, where you have to pay €772 per sub-fund. Even in Luxembourg, it's quite expensive. For single fund, you have to pay 2,650 and 5,000 for an umbrella, but at least it is for the full umbrella, whatever the number of sub-fund. In France, you have to pay 2,000 per sub-fund, which is a lot, and this is generally at the beginning, but also on an annual basis, which means that, okay, if you're a manager and you want to target a certain number of countries, at the end, it can be very expensive, so you have to think about it. But at least, again, we now know what it is. The second thing, which is very often a complaint from the industry, is the fact that in certain countries you need to have local agents, which does not seem very logical. It was the case at the beginning, for example, in France. They said that they wanted to have a so-called correspondant centralisateur, as they have for UCITS. And finally, the industry really said, but it doesn't make sense. I mean, in the passport, the idea is really to sell AIF to professional investors, so it doesn't make sense to have this kind of correspondent centralisateur locally. And finally, the AMF came back and said, no, finally, it's not necessary, and it's not anymore. But in other countries, and for example, in Spain, it's necessary to have an entity locally just to pay the fees to the authorities. So it looks strange because you have the feeling that maybe the AIFM could do the payment directly from its home country, but no, they want to have somebody locally, which can be a lawyer, it can be a bank, it can be various entities, but you need to have that, and it has to be part of your application file to say, okay, who will be my local agent, if I may consider that it is something like that, but it's just for the payment of fees. And again, it is something like 2,500 per registration or 3,000 per year. Okay. Other things are that in certain countries, when you do your application file, you have to include very precise information on the way you will avoid a retail client to become shareholder of your funds. So it's some authorities are very cautious about that. They want to make sure that you do all the things you have to do to make sure that you only target professional investors. For example, in Germany, they really want to have in the application file some description of the process you will have in place to avoid that marketing to investors that are not professional or semi-professional, since it's also possible to sell to semi-professional in Germany. They are also asking you if you're going to sell through internet, and in that case, they want to make sure that you have a dedicated access only for professional. You know, all these kinds of details have to be part of your application file, and if you do not have this information before starting it, of course, it will be rejected, and then it's another 20 days potentially for you to wait before having the opportunity to market the fund. Another thing is maybe the way you have to disclose your material changes. And for that, this is an issue because there is no harmonization at EU level, considering that the directive is saying, okay, if there is something changing based on your initial application file, you're supposed to inform the authorities. But what is a material change? And this is something which is not harmonized at all. So I give you the example of Luxembourg. Initially, when we talked to the CSSF, they said, we do consider that everything is material. They didn't want to take any risk. So they said, I want to be aware of everything. Okay. Normally, if it is something which is really important, you are supposed to give the information a month before. For that, they have been quite cool. They said, okay, as soon as you have the information, you can let us know. And after a certain time, then this is what we did for our client. Every time we had a new prospectus, or even the annual report, because the annual report is part of the application file. So you have a new one, you can consider that you've changed something which is part of the application file, and then you inform the authorities. And we did that. And after a certain time, the CSSF came back and called us and said, we don't want to receive the annual report anymore, because finally the local authorities said, we are not interested in receiving that. And basically, they received that comment from the BaFin, which is the German authorities, and they said, if the German authorities does not want to have that, probably the other will do the same. So, you know, it's still something which is under discussion, not very clear, but you have to keep that in mind to make sure that you cannot have a complaint from the authorities directly. So I would say that globally it works. I was 2 weeks ago at the ALFI conference in Luxembourg about alternative investment fund, and some asset managers were there. And one of them was BlackRock, so a very big one, and they say, oh yes, it worked, we are using that a lot. And it's really nice because now we can really do marketing on an active basis to professional investors with no risk of being qualified as doing mis-selling as far as you're targeting only professional. So I would say it's a success. You have to deal with, anyway, this kind of discrepancy, but this is also the case in the UCITS world. It has been implemented like that, and you cannot really change this. So this is for the how it works, I would say.
Thank you, yes. And I think that we've provided some information. Really, these slides are available also on the app for informational purposes as well. I think, Catherine, the continental perspective, I mean, I think we have a fairly good idea of how the AIFMD is being regarded here in the UK. Stephen's glad he's not talking about it, so that gives you some idea. Perhaps, obviously, you've discussed the fact that it is, working.
Yeah.
You mentioned BlackRock. Obviously, that's a big firm which has a lot of resources, and they're loving it because it allows them to do all kinds of things. But how's it going for some of the smaller players?
For smaller players, that's right, that it can be seen as something more difficult because, again, if you target a lot of countries at the same time, it can be considered as very expensive. And also because there are other things that you have to look at that are, for me now, really the real challenges of the passport is not the application file itself, because you now know what you have to do, but it's really making sure that you're in line with the idea of the passport. First of all, making sure that you're only selling your product to professional investors. And this is really important because, again, the passport is only for professional investors, except for Germany, when you can also target semi-professional, and Italy as well, you can also target semi-professional investors. But for all the other, it's only professional investors, and it's not always easy for an asset manager to be 100% sure that he's only targeting this category. And every time, finally, you target other categories, even if it is not retail, it's really high net worth, it's family office, all these categories, you can not use the passport itself, which means that you have to look on a country-by-country basis if you have other possibilities. So do you have to do a full registration? Do you have just to do a notification? Or is it something which is just impossible? And there are some countries where finally, if you're not targeting professional, there is no possibilities at all. So for me, this is really the first key challenge. And I would say, as you just said, Stephen, knowing your clients and have a real overview of your distribution process is key to make sure that you're applying for the appropriate application file, I would say. The second thing is really what you have here on the screen. Okay, yes, with the passport, you can do marketing, but that's once you have the passport already, which means that you prepare your application file and you receive the approval from the authorities. But what can you do before? And very often, especially in that world of AIF, especially in private equity and real estate, so managers are saying, yes, but I have to talk to my clients before. I have to make sure that there is an appetite for the product before just creating the product. So if the product is not created, I cannot do an application file for marketing. And then it's important to look again on a country-by-country basis, because if marketing is, I would say, defined, but all the things that are before are not defined at all, and at that level, there is no harmonization process. On the screen, I just wanted to give you an idea of that. We have the question on the small table on, is a draft document considered as, a circulation of a draft document is considered as being marketing? And the question is key, because if the answer is yes, that means that normally you're not supposed to circulate draft document before having your application, your marketing passport. If the answer is no, probably you can. In certain countries, it has been fixed. For example, in the UK, it's quite clear. In Luxembourg, it's quite clear. And also in other countries, for example, in Sweden, they say, you cannot consider you're doing marketing since your fund is not existing already. It's just draft document. And provided the client cannot subscribe, we consider that you're not doing marketing, which means you can talk to people locally and you're not in breach. In other countries, it's not the case. They say, no, as soon as you talk to clients about a product, you're in breach. In other, they are saying, you cannot talk about a product, but you can talk globally about your strategy. And then there is maybe a possibility to discuss with people locally. This is really crucial to make sure that you know before talking about your product and strategy in various countries, that you have a clear view of what are the requirements locally. And again, very often it's not in the law, it's just guidance, or it's nothing at all, and then you have to ask a local lawyer about it. Then for me, again, the two challenges are really making sure you sell to professional, or make sure you have a proper application file in line with your clients, and see what you can do before if you want to do something before. And again, to come back to your question, I think that for small player, it's probably much more difficult to address than for big player. Since, okay,
we're getting a lot of questions on reverse solicitation.
As well.
Our favorite topic. There are a number of questions. I was hoping that we would hit reverse solicitation at the end because we're going to run out of time. So what I'm going to do is we're going to go to Winnie for a second and then circle back and probably finish up with the 4 or 5 questions on reverse solicitation, which are attracting the most attention. So Winnie, if I could just move to you. Winnie, who's come in from Hong Kong. We saw on the poll that Asia, both China and excluding China, are of interest to people. Can you give us your thoughts on the role of Hong Kong in facilitating and attracting money out of China?
Mm-hmm. Sure. I basically would like to show you some of the uniqueness of Hong Kong. Because I'm coming from Hong Kong, I basically would have a much better concept or the familiarity of Hong Kong, and how do the UK, US managers or the local managers think about why I come over to Hong Kong, why not other places. First of all, Hong Kong has been since 1997 under this change of the sovereignty transfer, that we have been named as the Hong Kong Special Administrative Region under the one country, two systems. That means we have been so close to China, not just geographically, but in our mentality or in the political system, we have been much closer with China. And second point is proximity to China, because geographically, as I mentioned before, we are so close, and it's just over the river, I can say. And in fact, the Hong Kong government has been using a lot of the capital reserve to build the infrastructure to make sure that the two places, Hong Kong and China, are much more easily commutable. Just like the train or the bridge and the airport would be much better facility for people coming over Hong Kong, and then they can easily commute to China, let's say Shanghai, Beijing, or other parts of China. And Hong Kong actually, I think over the years, especially for the Securities and Futures Commission, so-called SFC, and other regulators, including Hong Kong Stock Exchange, has done a lot of things over the years. And I better put some of the timelines and some of the key items just for your reference. Hong Kong, in 2015, just last year, half a year ago, we have a mutual memorandum of understanding between the Hong Kong SFC and the CSRC, the China Securities Regulatory Commissions. We have that sort of mutual recognition of funds, MRF, on the 1st of July. I think the important day marking it on the 1st of July is the date we return our sovereignty to China. That may be the point that they put it on that particular day. And given that sort of...
Jonathan, do you want to just move the clicker for, so that we can go move forward to the...
Is it?
Yep, keep going. Okay, go ahead.
Yeah, just at the bottom part of the slide, that we have the mutual recognition of funds, and it has gained a lot of recognition and gained a lot of response from the market. And the SFC, the local regulator, has been quite busy approving the funds between Hong Kong, and they are trying to make a way to smooth the regulatory system between the two. Even we are, Hong Kong and China are so close, and our regulatory system, there's still some discrepancy, differentiation, and even we are Chinese, we have that sort of Chinese mentality difference in mainland China and Hong Kong, because we have been brought up under the British colony for so many years. And the Chinese mentality would be a bit different from us. And that's why we have that sort of regular communication between China and Hong Kong for these two regulators, the Hong Kong Securities Futures Commission, as well as the China CSRC, the China Regulatory, China Securities Regulatory Commissions. And there are another crucial influence to the market is the Shanghai Hong Kong Stock Connect. It's rolled out in 2014 on the 17th of November 2014. It was rolled out, and it was a mutual communication between the two exchanges. Is Hong Kong people can go to China no need to go to China, but they can. They can paste their orders to trade with the China A shares. And at the same time, then the Chinese, mainland Chinese can, trade the Hong Kong Stock Exchange, the Hong Kong stock listed stocks. That's the key, milestone of the Hong Kong Stock Exchange over a year. And we have, in Hong Kong, have done a lot of efforts in rolling that out, because before the system being rolled out, there has been much of the testing, and the two regulators has been communicating very frequently, including the Securities and Futures Commission. They have been involving in the whole process. And Shanghai and Shenzhen Hong Kong Stock Connect, the last point that I want to bring to your audience is it will soon be rolled out, and it has been hesitating or has been delayed for half a year because of the volatility of the stock market over the third quarter and fourth quarter of 2015. And we are trying to make sure our Hong Kong Stock Exchange, as well as the China government, would like to make sure that everything is fine. And after that sort of mini breakdown, or that sort of financial, it's not a major one, but there has been some test to the Chinese government, then it is the right time to roll that out. And we are patiently waiting for that to happen in 2016. I'm going to give you a bit of the different ways of going through the funds, how do they go in and out of China. There are a number of ways. I'm not talking about, because I know a lot of the illicit ways of getting money from China. They can be underground or whatever. But I'm not talking about that sort of things, or full gambling in Macau casino, that sort of things. But we are talking about all the compliant ways of doing that sort of things out of China and in Hong Kong. One is QDLP, Qualified Domestic Limited Partnership. It's so many names, so many acronyms here. But I don't want to go into that sort of details to you guys because it's boring to you. But I just want to give you a concept. There are different ways that the Chinese government has been trying to put through. And the second one is Qualified Domestic Investment Enterprise. And the third one is Qualified Foreign Institutional Investor. The fourth one is Qualified Domestic Institutional Investor. They all start with Q. Then you can take 4Q out of that conference afterwards. Basically, they are just talking about the test. Just like you throw the stone into the river. The Chinese government is not, at one time want to roll out in a very expedited way, but they just want to take it on a step-by-step phase basis. Just like the Qualified Domestic Limited Partnership is talking for just one Qualified Domestic Limited Partnership. It's about renminbi 50,000 to 100,000. It's not that much. If you are talking about for each of the company, if it's setting up like that, that is not much. But the quota once is used, then the Chinese government is going to increase the quota. And that's why they are just testing on a phase-by-phase basis to see the response in the market and see how the regulatory system in the two countries or with different jurisdictions can align. And I don't want to go into details for others, then you can pick up the slide afterwards. And I need to make some promotion for Hong Kong, even I'm not for that sort of role. But Hong Kong is actually an international financial hub, just like US and New York and the UK, London. And it's just like our Hong Kong is just like a stadium gathering most of the major players from all the large institutional banks, investment banks, and from different parts of the world, and then they can gather together. And because Hong Kong is so well regulated, I can't say it's as sophisticated as in the US and the UK, because when I talked with our internal training manager yesterday, he told me, there may be 2 or 3 generations that in the teaching process that you need to align with the to change the mentality of the people. That means for the regulatory system in the US and the UK would be very, very sophisticated, but that may be, it takes time to align with the Chinese government or to align with the Hong Kong, SAR.
Winnie, sorry, Winnie, we were kind of running out of time. If you can just tell us, how do we get money from China?
Well, basically, there are 2 ways. I'm just thinking of myself. I'm going to work in London Cordium, or I work in Cordium Asia. It's just an analogy. I mean, are you going to set up your company in China, or are you simply through Hong Kong to get into China? If I were not that sort of having a very strong background of China, I would stay in Hong Kong. Hong Kong usually give me the stability or safety that you can rely on the regulatory system. And all the facility or infrastructure, as I mentioned before, is so easy that you can come over to China. Or you want yourself to familiarize the firm or the culture or to step into China is the next step. I would put it in this way.
Okay, so really it's a focus on whether you should have a local presence or not is a key issue for you. I think that we are going to have to wrap up soon because apparently the coffee is going to get cold. There have been a number of questions. Jonathan, we're going to have to get to you very, very quickly here because I think that the Middle East didn't actually score as high as I thought it might. So I think we can sort of safely skip that to some degree. But clearly one of the reasons why we were talking about discussing this with you was, to talk about a little bit what we're seeing on our side. Obviously, as a hosting firm, we deal with a lot of our clients and their attitude towards the EU. Maybe you can just talk a little bit about the managers we've got coming on board and how they look at the AIFMD.
Yeah, absolutely. I think what I pick up on Catherine's slide here, and a number of the funds that we deal with are limited partnerships, private equity and real estate funds. And as you'll see, you have to have final documentation you can't go and market or with draft documentation. However, if you're going to go and apply for a passport, you have to have final documentation to request a passport and also a limited partnership agreement signed. So you can see there's a lot of people out there that are really struggling to work out. And BlackRock find this easy, but there's some of the smaller managers that they have a European fund, they think it's going to be easy to market, and they come up with a hurdle like that. So people are putting together final documentation as final as they can and signing very founder agreements with the partnership to allow them to get into Europe. I think the other thing that many of our clients are struggling with at the moment is the disparity. The AIFMD everyone hoped would be a harmonising directive and things would be treated the same. But as we've seen and heard about fees are difficult. I was on the phone to the Norwegian regulator trying to work out what they're charging. And they told me, we're not sure we're going to charge you a initial fee, and we might charge you an ongoing fee. We've got that in our laws, but we haven't quite decided how we're going to charge. So trying to plan, I think, which jurisdictions you're going to go into is very, very difficult. And the real kind of planning, and with the Middle East as well, I think it's all, I think we've heard across this panel that it's all about trying to understand what investors you're going to go and find. Middle East, often you need a local representative unless you're going to the very highly sophisticated investors. And I think that's similar to what you've heard in Switzerland and Europe. And I think all our clients are taking a kind of step back at the moment, trying to look at where they're going to market, trying to decide who they need to to market too, because a lot of them come through the door and speak to us and haven't decided which jurisdiction they're going to put a fund in. And I think a lot of that is where that money is going to come from. Clearly, Germany's pretty close from a private placement perspective, as is some of the other southern European jurisdictions. But if you're trying to get US money and others, I think it's still an open market. So I think that's what we're trying to be very quick in wrapping up.
Yeah, sorry, we've kind of run out of time. There are a lot of questions on reverse solicitation, so I'm going to ask for less than 5-word answers. Stephen, does reverse solicitation still work? Actually, does it work in Switzerland? You answered a lot of questions. There's a couple of questions here. How does reverse inquiry into Swiss marketing work for new clients, i.e. no document or PPM exists? Is it just at the idea stage?
It works temporarily. It doesn't later if you're successful.
I love that succinct answer. I think that the highest voting question was, considering the difficulties in raising capital in Europe outside of the passport, don't you think it's still possible to rely on reverse solicitation? Catherine, the answer is no.
No, honestly, I think you have to be very, very careful with that. Of course, there are some possibilities, but very often there is no definition in the various countries. And even when definitions are existing, then you see that it's not that easy because finally, and I'm taking the example of Luxembourg, so it has to be really at the initiative of the investor. This is what you just said. You have to give to be able to prove that it has been at the initiative of the investor. So no solicitation at all. And very often you need the written confirmation from the investor saying, yes, okay, I have solicited by myself. Which means also, as I mentioned on the slide, that you need to keep record of that. That means that you have to put in place a system to administer all these requests. And really, in 2 words, if you're a small asset manager, it's difficult to explain that all your subscription came by reverse solicitation. How is it possible that you're well known? And if you are a big one, honestly, you try to do much more bigger marketing campaign. So you want to do real marketing campaign. So it's not a solution in that case neither. So, okay. Of course, if you're doing marketing campaign in 10 countries and you have one big client who want to go from another one, maybe, yes, in your book, you will see that for this country, it's only 1 or 2 subscription. Yes, you can say it was reverse solicitation. But be very, very careful with that because the authorities are now much more cautious than they were in the past. So for me, it's not a marketing strategy at all.
Joe, I think I'll just add that it'll be fine until you're having bad months. And then when investors see you're having a period of poor months and they work out a way of saying, actually, you weren't kind of appropriately registered to market a fund, what will the implications of that be? And I think that's where you have to be very, very careful.
That's when compliance comes in, isn't it, when things aren't going well?
Joe, just one. My 5-word answer would be most managers are still doing it, reverse inquiry. That's the reality.
Yes.
Even in the UK, it's probably only at best 20% of the full-scope UK AIFMs have said to the FCA that they're marketing in the UK, which is scarcely believable, I suspect.
Yeah. We'll have to wait and see if the regulator catches up. The people that wanted to ask the questions of Pat, he is going to be around all day, so please grab him a coffee. But at this stage, we have to call it a day. Thank you very much to the panelists. Thank you.